What's up guys, and welcome back to Wall Street Millennial. If you've been following this channel, you know that we cover a wide range of topics related to stocks and investing. Today we're going to reveal some of the top positions in our own investment portfolio. Keep in mind that we are not financial advisors, and this video is only intended to share some of our own opinions and rationales for our stock positions. As always, make sure you do your own research and consult with a professional before making any investment decision. In this video, we'll go over the top 3 stocks in our portfolio. The full list of 13 stocks are available on our Patreon platform, which we just launched today, but more about that later. Our first position is Tesla. Based on the unusually poor like to dislike ratios and comments on our Tesla related videos, it seems like a lot of you aren't the biggest fans of Tesla in the world. And with the stock having more than 10x in value over the past 2 years, it's true that most of the easy money has already been made. But we still believe the company's leading-edge technology and Musk's visionary leadership will eventually take the company's market cap above $1 trillion. For each of our positions, we've made a valuation model and research report analyzing the company and explaining our investment thesis. In 2020, they finally made an annual net profit of $690 million. But this included $1.5 billion worth of regulatory credit sales, which will decrease as other automakers ramp up their own EV production. For simplicity and conservatism, we assume that they make no money from these sales going forward, even though they did make some in the first half of 2021. We made projections for each of their vehicle models over the next 10 years, and we expect a lot of growth in deliveries once the Berlin and Texas gigafactories become operational over the coming years. But just selling cars alone isn't enough to justify Tesla's current $730 billion market cap. We believe the real upside for Tesla will be from their full self-driving technology and eventual robotaxi network. Here's our research report for Tesla. In it, we go into detail about Tesla's autonomous driving technology and the economic potential of the robotaxi network, which we think could easily become far larger and more profitable than Uber once operational. Tesla has already proven their full self-driving technology, and they continuously improve it as they get more real-world driving data from Teslas on the roads. The main uncertainty is when they will get regulatory approval for a fully autonomous taxi network, as the regulators are very conservative with regards to self-driving cars. If everything goes according to our projections, Tesla could make more than $50 billion of net profit. This would justify a market cap in excess of $1 trillion based on a 20 times price to earnings multiple. Most of these projected profits will come from the robotaxi network. We rank each of our stock holdings with a risk score from 1 to 10. We give Tesla a high risk score of 8 as there are significant uncertainties regarding the timing of the robotaxi network. Also, because the stock price is already so high, there's not a ton of upside left, and our time horizon is pretty long. Our 2027 price target of $1,023 per share only implies a 5.8% annual return. So while we like Tesla's stock, it's not our highest conviction position. Next off, we have Virtu Financial, which we think has much greater upside than Tesla and is also less risky. We give it a risk score of just 4 out of 10. Virtu is a market maker, which means they sit between other market participants who want to buy or sell stocks, options, or other assets. They only make a few pennies off of each transaction, but they trade at such high frequencies that this adds up to hundreds of millions of dollars worth of net trading income every quarter. Importantly, they benefit from high market volatility and trading volume. The greater the market volume, the more transactions there are for Virtu to market make on. When volatility is high, spreads widen and they can make even more profit from each transaction. They had a blowout year in 2020 as their revenue and profits were boosted by volatility and increased volume as more retail traders entered the market. In the first quarter of 2021, they also benefited from the GameStop and AMC short squeezes, which caused unprecedented volatility. In 2020, they made a record $5.10 of comprehensive earnings per share. This is a huge number given that the stock is only about $25 per share. Of course, 2020 was an exceptionally good year for them, so we should not expect them to repeat this going forward. But they're off to a good start in 2021, making $2.56 of EPS in the first half alone. We think that in a normal year, Virtu can make about $3 of earnings per share. This gives them a dirt cheap valuation of about 8 times price to earnings. But there are 2 factors which make Virtu even more undervalued than it appears on the surface. Firstly, the rise of commission-free retail trading is here to stay. While volume will likely moderate from the record levels of 2020, it will probably continue its secular growth trend upwards over the next few years. This could represent upside risk to our EPS projection of $3 in a normal year. But more importantly, Virtu's revenue, profitability, and stock price are all correlated with the VIX Volatility Index. We've written about this in detail in our research report. This correlation makes Virtu extremely valuable as a volatility hedge. Market crashes are often accompanied with large increases in the VIX, which benefits Virtu. For example, during the early days of the pandemic, Virtu's stock skyrocketed while the rest of the market was tanking. Because of this, we believe Virtu deserves a premium valuation. Based on our DCF valuation, we have a price target of $56, or almost 130% upside from its current level. It also pays an almost 4% dividend yield, which we view as very safe. The third position in our portfolio is Chinese e-commerce giant Alibaba. Alibaba is the largest e-commerce company in the world. It's about twice the size of Amazon as measured by gross merchandise value. The stock price has been cut almost in half since October of 2020, as sentiment around the company and Chinese stocks in general turned sharply negative. It all started with the disappearance of founder Jack Ma after he gave a speech critical of the Chinese government. There have also been some antitrust fines levied against Alibaba. Since the Didi fiasco in July, Chinese stocks in general have been in free fall. For a multitude of reasons, we think that these fears are overblown, and Alibaba stock could easily triple over the next 5 years. We've written a detailed report explaining why this is, as well as a valuation model. Instead of going over the full report in the video, you can read it for yourself for free. We just created a Patreon page today. If you decide to support us by becoming a patron, you get access to our entire stock portfolio with all the research reports and valuation models. We'll also post Patreon-exclusive weekly newsletters about significant market events over the coming weeks. By becoming a patron, you're supporting the Wall Street Millennial YouTube channel and helping us to continue delivering regular content. The link to the Patreon page is in the description below. If you don't want to become a patron, you'll always still get free access to the top 3 stocks in our portfolio, and you can find the link to this on the Patreon landing page. Links to the valuation models and research reports are on the columns to the right-hand side of the sheet. There will be no changes to the YouTube channel, and we will continue publishing the same type of content that we always have. Before we wrap it up, make sure to follow us on Twitter as well, link in the description below. We also just made the account today, and we'll tweet frequently about the stock market and investing. As always, thank you so much for watching, and we'll see you in the next one. Wall Street Millennial, signing out.